Hi there, and welcome to the Stockscores Market Minutes for June 21st, 2013. This week I'm going to discuss the importance of trading the hot market and why it's important on both a long-term and short-term sense. Let's get into that right now. Hot markets are those that attract the crowd, and because there is a crowd attracted to that stock, that sector, or that overall market, we tend to see a good perpetuation of the trend. Now, to find the hot market, we want to look for breaks from the first rising bottom, and if we do that on a weekly chart, then we found potentially the longer term hot market. Now, if we do it on the daily chart, then we're looking more to swing traders' hot market, and using the intraday chart, that's something for the day traders to consider. Now, it's important, particularly with shorter term trading like day trading or swing trading, to not only see that abnormal price action from a rising bottom, but also to find the abnormal volume that usually comes with the start of a hot market. Each day when I'm day trading, I look for the stocks that are trading abnormal volume and breaking from a rising bottom. If I'm looking for a swing trade, I look for abnormal volume and then look to the price action and so on and so forth. All right, let's get into the analysis for this week. The SP 500 had a pretty sharp decline last week after the Fed made its announcement, which was basically to say that QE is not going to continue forever. Probably not much of a surprise, and yet the market acted like someone had taken away the punch bowl. In the short term, I expect the market to bounce simply because we had a pretty sharp sell-off over 3 days. It wouldn't surprise me to see the S&P ETF here, the SPY, rally back into the 163, maybe even 164 price range in the very short term. But longer term, I think this market is destined to come back to that longer term, flatter upward trend line that right now is sitting at about $150. Now, over time, that trend line rises, so the downside on the SPY could be 152, 153, just depends on how long it takes for the market to get there. But I think in general, over the next little while, we're going to see a slow move to the downside. Now, we could get a sharp, quick move to the downside, but I don't think that's likely because I just don't see the catalyst for that strong fear-based sell-off like we had in past years. On the TSX, we also had weakness, but the TSX has the benefit of being at some fairly important support, and therefore it is likely to bounce in the short term. It is a market that has more or less been moving sideways for the past year, with a fair bit of volatility because of the uncertainty over the last 3 months, particularly surrounding commodity-based stocks. In general, there's not a lot of great opportunities on the TSX. You do get the odd one once in a while, but you really got to focus on the abnormal action that makes that stock stand out from the rest of the Toronto Stock Exchange. 20-year Treasuries have had a sharp fall as the market prices in the end to the stimulative action by the U.S. Federal Reserve. And of course, with the news that came out on Wednesday, we've seen a pretty strong sell-off in the bonds, but that really started 6 or 7 weeks ago, and I think we're likely to bounce in the short term. But given that the downward trend is still intact, we're in that downward sloping channel that I've highlighted in red, don't expect that this market is going to become optimistic very quickly. The US dollar really rallied on the news that the US Fed will not print money forever. And again, not much of a surprise, but the market seemed to be shocked by it. It's somewhat hard for me to believe, but that is the way the market works, and it looks to me like the US dollar has made a good bounce back, but it's pretty tough to call. I don't think that there's going to be considerably more upside. In fact, I think we could see a little bit more of a rally, maybe up to 2260 on the UUP, which is the US dollar index ETF. But given that the strength in the past 3 days really comes out of a period of strong weakness, I think we're going to see some people selling into this strength on the US dollar. Gold continues to really suffer. It's been building that pessimistic descending triangle since mid-April when it suffered its biggest sell-off in a long time, and it has now broken down through that support level and continues to look like it wants to go lower. Now, in the short term, wouldn't surprise me to see it rally back up to 130 on the GLD, but use any strength in gold as a excuse to get out of positions, because it does look like gold is going to continue its downward trend. Oil tried to break that downward trend line. It did so for 4 days, but hard to overcome the strength in the US dollar, and that put oil back into its sideways trading pattern, which has a little bit of a negative slant to it given the falling top. So I am slightly negative on oil. And finally, the VXX, which has been dead for so long, continues to strengthen as it has over the last 5 or 6 weeks. It is not a considerably strong market, but on strong down days, the VXX is a great place to trade because it has so much volatility and so much liquidity. So if you're looking for a hedge against market weakness, don't hesitate to look at the VXX on those strong down days. So my outlook then is bearish on US stocks, simply a matter of some profit taking after a very good run to the upside. Canadian stocks are neutral, but let's not kid ourselves. There's not a whole lot of action in the Canadian market right now. Gold continues to look bearish, and oil neutral, but with a pessimistic outlook. You know, this past week, the market dynamic changed, and it's now a case where we have to look for where money is going to rotate out of and into. The hot stocks have been the dividend payers, and it looks to me like money is going to come out of those stocks and continue to do so. But where is it going to land? That's not yet clear. So we got to watch the market very closely for those sectors that attract buyer interest. A strong dollar has hurt commodities, but they are oversold in the short term and they should bounce. So don't be surprised to see a short-term bounce in gold, but don't get suckered into it either. The market is uncertain right now. Be cautious while it figures out its next focus. We may get our answer as we go into earnings season, which of course begins very soon. Well, that has been the Stockscores Market Minutes for June 21st, 2013. Have a great week in the market and trade well.